At 4:38 on a December Friday, Eli sits in his pickup work boots on the mat trying to remember 11 months of driving. His bookkeeper asks for mileage. Eli sends 3,000 work miles. Then he waits, hoping nobody asks the question he cannot answer today. Did those miles run from the shop to customers? From home to the shop? Were supplies, detours, and personal errands mixed into total? The IRS set the optional 2026 business standard mileage rate at 72.5 cents per mile, effective January 1st, an increase of 2.5 cents. At that rate, Eli's 3,000 properly documented business miles would produce a $2,175 reimbursement. At last year's rate, those same miles meant $2,100. $75 isn't the story. The story is whether $2,175 belongs outside wages, inside job costs, and backed by proof at all. The federal rate covers business use of cars, vans, pickups, and panel trucks, whether they run on gasoline, diesel, batteries, or hybrid power. That sounds simple. Until size, every vehicle carries a life, school drop-offs, morning commutes, emergency calls, and the occasional hardware store detour on Saturday. Eli's mistake was not driving a personal truck. It was treating the year as one blurry trip instead of hundreds of provable decisions. The standard rate is optional. A business may instead use actual vehicle costs, but that choice carries record-keeping work and vehicle method consequences later. Before choosing, Eli needs two answers: what the truck truly costs the business, and how much administration his small team can sustain monthly. The cheapest-looking method can become expensive when receipts disappear, payroll gets corrected, or technicians stop trusting the company's reimbursement process under pressure. Publication 463 says business travel needs adequate records. The evidence should establish the amount, time, place, and business purpose of each expense claimed. Picture Eli, on a Tuesday, shop to a remodel to a supply house to an emergency service call, then home. Publication 463 generally treats travel from home to a regular workplace as commuting, even when the worker carries tools or plans the day. The clean question is, where did work begin? Firmly. For many teams, home to shop is personal commuting. Shop to client is business travel under policy. Trips between business locations, client sites, and supply runs may qualify as business transportation when they are connected directly to the company's work. That distinction changes Eli's log. A route can contain both personal and business miles, so he cannot simply record the day's odometer difference. Start with one written rule. Name each employee's regular work location, then explain how dispatches, home offices, and temporary sites are treated consistently. For every eligible trip, capture the date, destination, business purpose, miles driven, and either route detail or starting and ending odometer readings. Under an accountable plan, reimbursements need a business connection, timely substantiation, and repayment of any excess. Those three parts matter together to the IRS. When that workflow works, reimbursement can stay a reimbursement rather than becoming a vague allowance that your payroll system must untangle later. Eli's company could use a short accountable plan policy: eligible trips, required evidence, a submission deadline, approver, repayment rule, and clearly defined payment timing. Make the deadline monthly, not annually. A February trip reported in March is easier to verify than a December total remembered next winter. Without adequate substantiation, a payment that looked like reimbursement may be treated as wages, bringing withholding and payroll tax consequences with it at year-end. That is the expensive surprise. Exhales. The payment does not disappear. It may arrive as corrected payroll, extra administration, and a hard conversation. Pay only approved, supported mileage do the reimbursement process. Do not tuck a vehicle stipend into paychecks and hope labels solve it. Now, this does not require enterprise software. Eli has 4 technicians, uneven schedules, and a bookkeeper who needs clean information before payroll closes. One approach is a form submitted after each trip, customer or job, destination, purpose, miles, and a photo of the odometer when useful. Another is a mileage app separating drives as they happen. The tool matters less than the habit of recording before memory edits reality. The standard mileage rate generally bundles operating costs such as fuel, repairs, insurance, depreciation, and registration into one per-mile calculation for eligible use. Business trip parking and tolls may be handled separately, but do not reimburse gas on top of the standard mileage rate without review. That double payment trap hides inside busy weeks. A technician buys fuel, gets a mileage check, and nobody notices payments cover the same wear. Your policy should separate mileage, parking, tolls, fuel cards, vehicle allowances, and company vehicles. Each category needs its own approval path and owner. For an owned vehicle, choosing the standard mileage method in its first business use year preserves the option to use that method again later. So when Eli replaces his truck, he should pause before treating that choice as a bookkeeping detail. The first-year decision can narrow options. For a leased vehicle, using the standard mileage method generally means staying with it for the entire lease period, including renewals that follow. Consider asking a tax professional to compare methods before a new truck enters business use, when payments, repairs, or business use are high. Actual expenses may fit some vehicles, but they require receipts, allocation work, and discipline records. Simplicity has value when payroll week is crowded. Ellie's truck hauls conduit, ladders, and testers through mud and snow. That may make actual costs worth modeling, not assuming from memory alone. Have the bookkeeper estimate annual business miles, total miles, fuel, insurance, repairs, lease or depreciation, and registration before comparing the two methods carefully. The 2026 rate applies across gasoline, diesel, hybrid, and fully electric vehicles, so Eli's future powertrain does not remove the logging requirement. Fair reimbursement is not about rewarding the loudest driver. It is about applying one understandable rule to the miles the business actually needs. Once the log is clean, use it beyond taxes. Attach mileage to jobs, territories, and customers, then see where travel quietly eats margin. At 72.5 cents, those 3,000 documented miles would create $2,175 of reimbursement expense, $75 more than the prior year's federal standard rate calculation. Spread that cost across service calls and picture sharpens. A distant customer may be profitable on paper yet thin after travel is counted. Ask technicians to connect drives to a job number, customer name, or service category. That creates a trail from windshield to profit report. Give one person approval responsibility. They need not investigate every mile, but they should question missing destinations, unusual routes, and late submissions. Ely once drove 40 minutes for a part because the nearby supplier was out. That trip belongs in the log, with the reason. A monthly cutoff protects everyone. The technician knows when cash arrives, the bookkeeper knows what closes, and the owner sees travel before margins drift. During the first 3 months, review submissions weekly. You are not hunting mistakes. You are teaching the rhythm before shortcuts become the culture. Keep a small exception list: missing purpose, missing destination, duplicate fuel request, late report, or route that needs a quick explanation from driver. Then sample a handful of trips against invoices, dispatch records, or customer appointments. Small checks make the policy feel real without slowing fieldwork. Publication 463 emphasizes records made at or near the time of travel. A reconstructed annual guess is weaker than a contemporaneous trip log. Ely can keep it simple: log the trip before leaving the driveway or immediately after parking, while destination and purpose are still obvious. If a day includes calls, record each leg separately. One daily total hides the difference between a customer visit and a commute. Build the prompt into the workday, close the job, capture mileage, submit the entry, then prepare for the next call before driving away. The IRS views a timely record as strong evidence because memory fades. A same-day entry can beat elaborate year-end reconstruction when reviewed. If last year's log is thin, do not invent certainty. Warmly gather invoices, dispatch history, and calendars, then ask a tax professional. Use that reconstruction only as cleanup. The real win is a fresh 2026 process that prevents Eli from facing the December fog again. On Monday morning, create the template, choose the approval owner, and set the first monthly deadline. Do not wait for a perfect system. At the next crew huddle, walk through 3 examples: home to shop, shop to customer, and customer to supply house. Let questions surface. Founders need this discipline too. If you drive your own vehicle, your personal convenience and your company's deductible travel still need a boundary. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor or business consultant before making significant financial decisions. Write the policy on one page: qualifying trips, required fields, submission timing, approver, payment timing, excess repayment, and rules for fuel and tolls. Reimbursements under a properly run accountable plan are generally excluded from wages, while payments outside that structure can face a different payroll treatment. That is why mileage belongs with payroll conversations, not just expense reports. The tax treatment, employee experience, and labor cost picture all meet here. Do not assume 72.5 cents is a universal employer mandate. State rules and contracts may differ, so consider local guidance before setting policy. Use the federal rate as a reference point, then match your reimbursement policy to your workforce, vehicle ownership, customer geography, and professional advice. Your rollout can fit 1 week. Publish the rule, train the crew, start logging, review first submissions, and pay only supported miles thereafter. If this helped turn a loose expense into a workable system, like and subscribe. We build calmer operations, one signal weekly together. Ellie's 3,000 miles were never just a number. They were customer calls, supply runs, wear on a truck, and decisions business should see. Make the log while the trip is fresh. Then the 72.5 cent line becomes fair reimbursement, cleaner payroll, and clearer view of your margin. Remember, this content is for informational purposes only and is not financial advice.